Numerous markets and indicators we follow have broken down significantly in the past 5 trading sessions. If the markets cannot find their footing soon, another and faster leg down in risk assets could follow. Further weakness could allow those on the sidelines an opportunity to buy low in the coming weeks. In this video, we'll look at several charts outlining what to look for under bullish and bearish conditions. We'll start with a look at some support breaks in technology and some potential support that's still in the picture. We'll look at slowing momentum on the S&P 500, bonds relative to stocks, and in that case we'll examine some DeMark charts, another risk on versus risk off ratio in the form of junk bonds versus treasuries. We'll examine the chart of shorts versus longs. We'll point out some potentially bullish setups for China and emerging markets relative to the S&P 500 and point out some support levels that may come into play for the S&P 500 and risk in general. Using the temperature gauge analogy, in the last 5 trading sessions, the gauge has moved up into this area here. Risk markets will either stop and put some water in the radiator holding its support, or this gauge will move up into this area here very soon, followed by possible downside acceleration in stocks and risk assets in general. To view the video in full screen mode, use this icon in the lower right hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right hand corner of your video player. It's a daily chart of the NASDAQ. You can see we've broken below several trend lines here. We could get a bounce here, ADX red over green. Even if we bounce, most likely resistance here. This is a daily chart of the S&P 500 as of the close on October 12th. This looks very, very noisy. Easy to understand. This is Relative Strength Index, or RSI. This is where the market begins to roll over, and you'll note on a lot of the video charts that we'll look at today, the market accelerates to the downside after May 1st. The peaking process occurs between April 1st and May 1st. So in this area, you can see RSI clearly making a lower high. Similar situation today. RSI here looks similar to this point here. When we broke below this support level here, the S&P 500 dropped 87 points in 3 weeks from this point here to this point here. We have several forms of potential horizontal support. The levels to watch: 1429, 1418, and 1396. This is the same chart. We've just scrolled down a little bit. Notice during the rally here, Williams percent R for the most part stays in the upper bounds here as the market rallies. Here, rally begins. It comes back down below negative 80 here for Williams percent R after April 1st, which is part of the peaking process. In today's market, we've been below negative 80 3 times now. This period here is beginning to look like this period here during the peaking process between April 1st and May 1st as the stock market rolled over. On the bottom, we're looking at CCI. This is the Commodity Channel Index. You can use CCI with trend lines. Notice as the rally is moving up here in the stock market, this is the S&P 500. Once the rally begins, CCI never drops below negative 100 until this point here after April 1st. And then between April 1st and June 1st, it stays near negative 100. Once we rally, we're never down in this area here as stocks are rising up here. Once again, recently, as of the close last Friday, we're back in this negative 100 area. This here looks like the present day, which was part of the peaking process. This is a daily chart of TLT, or risk off, divided by the stock market, or risk on. When the ratio is rising, risk off is in favor. This is what risk on looks like for the most part. Here's where the market started to correct. The stock market started to drop here. You can see we've got a bullish breakout here, price in a daily chart. We do have potential resistance heading into next week here. RSI now above several downward sloping trend lines. This appears to be a bullish break. MACD black above, red bullish, histogram above zero bullish. Looks similar to this period here. If we can clear this piece of resistance on this chart, that would be bearish for stocks if this chart moves into this area. Now we're looking at the same ratio, TLT or long-term treasuries relative to the S&P 500. This is a DeMark chart. DeMark charts and indicators are proprietary tools from Market Studies LLC. What are we looking at here? A 9 up. This is a buy setup that occurred. Notice after the arrow went up and we made a higher high here. That's April 30th of 2012. This is just at the point where the stock market's downside started to accelerate. We're in a similar situation here. The ratio held here at this TDST low, which is a DeMark form of potential support. We don't have this 9 up arrow. It's possible we would come down here one more time to get the 9 up. But the fact that this ratio cleared this green line here tells you from a probabilistic standpoint, probably moving towards this propulsion target rather than this one down here. Previously, when we cleared the green line on a weekly chart, which is what we're looking at now, the ratio moved higher. Also, these DeMarker indicators, DeMarker 1, DeMarker 2, period 6 below tells you that you probably will try to revisit this low, which we've done. A period 6 above and a period 6 above tells you you will probably try to revisit this high, which we may be doing here, which would be bullish for bonds and bearish for stocks. Here, it said we would probably revisit this. We have revisited it, and this time it appears we're not staying below these lines for 6 periods, which is a buy signal for this chart, or at least a high probability entry point for this chart. Looking at the exact same ratio, we've just moved to a daily chart. We have a 9, a 13, and a 9, which indicates potential exhaustion for this chart. This would be bullish here, potentially for treasuries, and bearish for stocks. On this daily chart, we're above this TDST low. It appears that we're trying to overtake the green line, which would bring this upside target into play. It's not unusual for a market to reverse at these green lines and move back down. So next week, if we get into this area, that would somewhat confirm what we're looking at here. It's Sunday, and if we wanted to try to get some insight, we're looking at the same ratio now on a 60-minute chart up here in the upper left-hand corner. We have a 9 buy setup here that the ratio responded to. Here, we've cleared this TDST high. This tends to be bullish. We've also exceeded this upside propulsion magnet here, which tends to be bullish. We also have now a downside propulsion target that's moved up. So this chart also, DeMarker 1, 6 period, probably tells you that's not the high for this. 6 periods, again says even if you come down, this ratio on a 60-minute chart will probably at a minimum try to re-challenge this high here. As of the close on Friday, this 60-minute chart seems to lean towards being bullish for bonds and bearish for stocks heading into the new week. This is potential support if the stock market bounces early next week. We featured this chart on Twitter. You can find us by Googling this on Twitter. This is a daily chart of tech risk on divided by treasuries risk off. These are parallel trend lines here. Here's your April 1st to May 1st peaking process. The correction lasts from roughly April 1st all the way until June 1st. You'll notice the ratio broke below this trend line here, and that's where the acceleration started in the S&P 500. From this point here to this point here, the S&P 500 lost an additional 100 points. In the present day, we're again flirting with this trend line. This could still bounce here, acting as support. If you're a bull for risk, you'd prefer to see this ratio move all the way up into this area and really exceed this right shoulder here of this possible head and shoulders bearish pattern. If you're bearish, you'd like to see this white space filled here, which was similar to this decline for the S&P 500. Notice here on Williams percent R, I said the peaking process and correction for the S&P 500 began on April 1st and roughly ended on June 1st. So if we come down here, notice during that period, April 1st until June 1st, notice what Williams percent R looks like. It tends to gravitate down to the bearish end of the spectrum. This is a weak move up, and during that period, we never see any moves above negative 20. Starting to look somewhat similar here. This weak move looks similar to this weak move. Therefore, if you're bullish, you'd like to see something like this next week instead of this area here. MACD, fortunately, also looks similar. You can see during the peaking process here, notice MACD is staying below the center line, MACD histogram. You can make an argument that this half here looks like this half here. If you're bullish, you'd like to see histogram up in this area above the zero line next week. Why? April 1st here, June 1st here. Notice during the weak period for the S&P 500, histogram never moved back above. In June it did. That was a bullish signal. This is where the market is weak. This is a daily chart of EMB relative to TLT. It's the emerging markets bond ETF relative to treasuries. Emerging market bonds tend to be more risk on divided by risk off treasuries. You can see when the market peaked, we said the stock market peaked between April and May of this year. The downside accelerated after May 1st. You can see this ratio risk on broke a trend line here around April 1st, and then the original slope off of this low was violated in early May, which was a bearish sign. From a bullish perspective, in the present day, these trend lines are still intact. So if you're a bull for risk, you'd like to see this ratio rise next week and hold these trend lines. If you're a bear for risk, you'd like to see both of these trend lines violated. You can see when the stock market rolled over here, this is April 1st, this is May 1st, RSI on this chart started to look bearish by remaining below 50. That's not what we have in the present day yet. In fact, this is trying to hold above 50. So if you're bearish on risk, you'd like to see RSI come down into this area next week. If you're bullish, you'd like to see this green line hold. Looking at the same chart, we've just scrolled down a little bit, EMB divided by TLT daily. Notice here when the rally in risk continued early in 2012 that Williams percent R for the ratio held at the center line here. We're trying to do that again in the present day. If this can hold and we can stay out of this box, all things being equal, that's better for the bulls. CCI, where you can draw trend lines, risk on, the rally started to become in jeopardy or in doubt When this trend line was broken here, what once was support now acted as resistance here on May 1st. You can see when the stock market peaked between April and May here, CCI, this trend line was violated. This is what the peaking process looked like for CEI, pretty ugly for risk. If you're a bull, you don't want to see CCI come down in this area. You'd love to see it move back up next week. This is another risk on divided by risk off ratio. This is the JNK or junk bond ETF divided by treasuries. This is a daily chart. April 1st here, May 1st here. This is the peaking process for the S&P 500. The ratio, this is risk on, breaking a trend line here near April 1st. You can see for the most part, these trend lines in the present day are still intact. Even if we break here, the initial slope off of the low in June could provide support here. So there's a little bit more hope on this chart in the present day than there was here during this peaking process. Notice when the market rolled over on May 1st, RSI here for this ratio clearly broke below 50 here. If you're a bull in the present day, you'd like to see RSI remain above this blue line. If you're a bear, you'd like to see it fill this white space for this daily ratio chart. Same ratio on a daily basis. We've just scrolled down. Williams percent R looks at market momentum. We said the market peaked between April 1st and May 1st. Here's some weak momentum here, followed by a skinny spike. We just had weak momentum here. You can make an argument that this looks similar to this on April 1st. If we go down and look at CCI, between April 1st and May 1st, we came down below negative 100 here for the first time since late November. Therefore, in the present day, if you're a bull, you'd like to see CCI remain out of this red box. You'd like to see it move higher. If you're a bear, you want this region here to begin to look like this region here. This is a weekly chart that we featured on our blog Short Takes last week. This is a PSQ technology short relative to the S&P 500. You can see here the ratio broke above a trend line here. Step 1, step 2 for a trend change, made a higher low. Step 3 here, this is a trend change, corresponded with the peaking period between April 1st and May 1st. Notice when we have the breakout here, this is a weekly S&P 500. Stocks declined further. The present day, we have a similar situation. Step 1, here's the higher low. Step 2, here's the higher high. This period here on a weekly chart, as of roughly late April, looks similar to the present day. The market rolled over. If you're a bear, you'd like to see Williams percent R on this ratio chart move up and look like this in the coming weeks. If you're a bull, you'd like to see this reverse and remain down in this area here. You can see the ratio of PSQ divided by the S&P 500 had a bullish MACD cross between April 1st and May 1st, which is part of the peaking process in the S&P 500. We do not yet have the bullish cross. We're very, very close. Also, Williams percent R seems to have moved into an area that was similar to this area here. If some of the support levels that we've shown previously in this video give away for risk on and the stock market is weak relative to bonds, it's possible that emerging markets and or China may be a relatively safe place to hide in terms of risk on. We're looking at FXI or China divided by SPY, the S&P 500. This is a weekly chart going back here all the way until 2009. You can see the ratio is making clear lower lows. Point to point here is the red line. We have a bullish divergence for China relative to the United States. Point to point, look at that slope. Point to point, look at this slope. That's a bullish divergence for MACD histogram for China relative to the United States. We also have a bullish breakout trying to form here in RSI. You can notice during this period of here of weakness for China, RSI rarely pokes its head above the 50 line as we're doing now. If we scroll down a little bit, you can draw trend lines on CCI. This is a trend line going all the way back until 2010. You can see we violated these two trend lines here in a bullish manner. I have to keep an open mind. There is a trend line here that this could run into soon, but it tells us that FXI may be a good thing to own relative to the stock market. This ratio here of SPY, or the S&P 500, risk on relative to risk off. This is AGG, the aggregate bond ETF. When this is moving up, it's risk on. That's risk off, risk on. This is a weekly chart. This is a bullish, potentially inverted head and shoulders pattern in black. You can see we broke the neckline here in early September in a bullish manner, and since then it's been give back time. That's obviously bearish for risk and bullish for bonds. The however coming is this trend line here, and these trend lines could act as support. So if you're looking for a bounce for the stock market or risk in general, there is hope for that as long as we remain above this box here. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.